Hi, I'm Jim Jubak, and welcome to my YouTube video, Quick Pick. We're going to do something a little different. This week's Quick Pick is EUM, that's an emerging markets short fund, versus EMXC, which is a emerging markets long fund, except for China, and we're going to talk about doing a put option on that. Okay, so basically we're talking about two ideas for shorting emerging markets. I've talked a lot recently about the emerging markets debt bomb. It's very clear that we're seeing a big slowdown in a lot of emerging markets economies, all of that. Let's look at a chart for EM. You can see this has been down for pretty much all of 2022, and it shows no signs of stopping. If you want to bet against emerging markets, which I do for the next 6 months or so, I'm not long-term bearish. So the question is how you go about doing that. Well, one way you could do it is by buying shares of a short emerging markets. This is a chart for the ProShares Short MSCI Emerging Markets ETF, or EUM. It's been up about 19.8% for the year to date. But you see, one of the things about this that you need to recognize is these big volatility lumps. This is indeed one way to play being short emerging markets, but it has a lot of volatility in it, and that's a problem. This is a chart for the iShares MSCI Emerging Markets ex-China ETF, which means it's all the emerging markets except for China. The upside volatility in emerging markets right now is coming out of China. If the Chinese government says, hey, we're going to put $200 billion into the financial system, we get a strong rally in Chinese stocks. Doesn't mean anything. It means squat for the rest of the emerging world, but the index, which has a heavy weighting toward Chinese stocks, goes up. So you get this big move upward, and then you sit there and go, okay, so I still believe the story is downward for emerging markets, but I've just taken a big beating, so maybe I'll sell. And that's the danger here. So what I'm looking for is something that takes some of that volatility out. The EUM is a relatively simple way to go short. You simply buy the ETF, and it puts you short, and it's basically an inverse to the long market. So that's what you get. But you also still get all the China volatility. There is no, as far as I can find, fund that shorts the emerging markets ex-China. The best you can do is to go and buy put options, which is a bet that the price will go down on the emerging markets ex-China ETF. The problem with that is that the puts aren't highly traded. The spread between the bid and ask is very, very high. The ETF is trading at about 46, 47. To buy a September 16th put at 45, which means you're betting on it going below 45. The spread is between a zero bid and a $1.70 ask. Big spread. You could wind up losing money even if the fund moves in the direction you want. Sometimes there's really no great choice. I would probably go with the EUM, despite the fact that it has more China exposure than I want, as opposed to the put on EMXC, because there's just too much option market volatility. So thanks for watching. It's been Jim Jubak. If you'd like this video, please like it. Subscribe to my YouTube channel. We do about 3 or 4 videos a week. If you subscribe, you get notification when we do the next one. If you want more of my stuff, you can go to my paid free site. That's jubakpicks.com. If you want more, you can go to my paid site, which is jubakam.com. Links to both of those are down below. Thanks for watching.